Let me show you how you can live off of your rental income by following this real estate wealth formula. If you can generate a 7% cash on cash return from your rental properties, and yes, this is possible, I'll show you how to do that, and you wanted to live off of $100,000 a year, well, that would mean that you would need to invest around $1.4 million today, generating the 7% return to live off of this $100,000 a year in cash flow. But the mistake that so many people make when it comes to investing in real estate is the first question they ask is, how do I underwrite the deal? But there are 3 steps that you have to understand to really succeed as a real estate investor. And that is number 1, understanding the location of where you're investing. Number 2, understanding the property that you're investing in. And then number 3, understanding the numbers. And that's what I'm going to be going over in this video in this order. So let me start by talking about number 1, the location. Now, just so we're on the same page, everything that I'm discussing today are not random things that I've read in a book somewhere. These are things that I have learned from my own experiences because I've been investing in real estate for about 13 years now. And there are 3 things that I like to look at when I'm investing in a certain location. I want to see, number 1, where our business is moving to. Number 2, where are people moving to? And number 3, where is the money moving to? And what you'll see is that all 3 of these almost move always in tandem. And the reason why is because when businesses move into a certain neighborhood, people have to work in those businesses. And as people work in those businesses, the money follows the people. Now, the question you might be wondering is, how do you figure out where businesses, where people, and where the money is moving to? And there are some very expensive publications that you can subscribe to, which are great. But an alternative, if you don't have thousands and thousands of dollars to go and subscribe to these publications, is start walking around certain neighborhoods. And when you walk around, I want you to go into the coffee shop and ask the barista there 2 things. Number 1, do you live here? Yes or no? And if he or she says, yes, I live here, ask them, how do you like living here? If they don't live there, then you ask them, why don't you live here? And the reason why is because you're going to get one of 2 answers. Either you're going to hear people talk about how much they love it here and how much they wish they lived here or how much they enjoy living here, or you're going to hear people saying, I don't want to live here and I don't like living here because the crime is getting worse, because the whole area is getting worse, because it's not a very safe place to be. And this is going to give you a very nice indication as to if this is an area that you even want to consider investing in. But now let's back up a little bit. If we go a little bit up from the neighborhood, which city and which state do you want to invest in? Now, I don't want to get political, but the reality is there are some cities and some states that are more landlord friendly, and there are some cities and other states which are more tenant friendly. And the difference between a tenant friendly state and city and a landlord friendly state and city is that it is going to be more difficult for you as a landlord to potentially collect certain payments or kick out tenants if you're having issues. If you are in a tenant friendly state, for example, California, it can be very difficult, very expensive, and very time-consuming to kick out and evict a tenant if they are not paying. It could take months, and in some instances, years, and a lot of dollars to finally kick a tenant out and then finally release this property if you have a bad tenant. Now, of course, if you have a good tenant, you got nothing to worry about, but there's always going to be times where you're going to have bad tenants. Other areas that are more landlord-friendly will give you the ability to kick out a tenant faster if they're not paying. Then you have certain areas like Michigan, for example, which are kind of on the middle. And then you'll have certain cities within Michigan that are more landlord friendly and other cities in Michigan that are more tenant friendly. So as you're doing your research, there's a couple things you want to be thinking about. Number 1 is this area, this neighborhood, the city, the state, is it more tenant friendly? Is it more landlord friendly? Number 2, is the money moving in or is it moving out? And then the 3rd thing that I want you to think about is, where are the people moving? And when I invest in certain areas, particularly cities, what I like to look for is, are the populations in this city, is the population in this neighborhood going up, is it going down, or is it staying sideways? Google has made finding this information super simple. You can just do a quick Google search to see if the population in a city or a neighborhood is rising, falling, or staying the same. And I want to be investing in a neighborhood or a city where the populations are rising, or at the very least staying the same. I don't want to be investing my money into an area where people are moving out of, because if people are moving out, that means you have less demand for properties in the area. And if demand is falling, well, that means, well, you might have a limited supply of homes available, but less and less people that want to rent your home. And that's not a situation that I want to be in. You want to be in an area where more and more people want to live, because that's going to give you the ability to raise rents. Once you identify a certain location that you want to invest in, this is where you can start looking at the types of property that you want to invest in. And in general, you have 2 different categories of properties. You have turnkey properties and value add properties. Turnkey properties are your properties that are ready to go. These might be apartment complexes that are fully rented out. They have tenants already there that are paying rent and you're just buying the cash flow. These might be single family homes that are already nicely renovated. You just have to come in and put a tenant into the property. A value add property is the opposite. This might be an apartment complex that is 80% vacant and the 20% of tenants that are there are not paying rent and they're just causing problems. This might be a single family home that has holes in the walls, that has the nasty carpets that just looks ugly. These are properties you're gonna have to come in and put in work. Now, take a guess, which one do you think is gonna pay you the higher rates of return? This one. The value add deals. Higher risk, but also higher potential returns. Higher risk here because now you got to deal with contractors, you got to deal with the city, you got to deal with the work, and then you got to figure out if you can actually get it leased. This one, especially if it's a cash flowing property, if this is a commercial building, whether it's an apartment, an office building, a storage unit that's already leased out, you're just buying the cash flow. And because it's already established, you're going to get lower rates of returns because there's less risk involved. Me personally, I prefer these value add deals because to me that's more fun. I like revitalizing communities and I like the idea of getting higher rates of returns, and I've been able to build a good team in my real estate community. That way now I have good contractors that I can deploy, that way we can go out and turn these properties around. But some people don't want to deal with the headache, which is completely fine. You got to find what's right for you. And certain types of properties are going to come with higher returns. So now when we go back to the question of what type of return is good for you, well, it's going to also depend on how much work you're going to do to get this property turned around. Because most people are going to walk into these value add deals and they're going to say, absolutely not. This is ugly. This is disgusting. This is never going to work. No one's going to ever make money here. And they're going to walk out. But those create the most opportunities because you have the least amount of buyers for these types of value add deals. And everybody walks into this saying, wow, this looks beautiful. This looks amazing. Oh, wow, this is a cute little property. And those oftentimes come with cute little profits. Not necessarily a bad thing, but it's simple, easy, ready to go, lower risk, lower potential return, higher risk, higher potential return, which brings me to number 3, which is understanding the numbers and the financials. But I want to remind you that if you're an investor and you want to stay up to date on what's happening in the financial markets, when it's happening, a simple thing that you can do is join Market Briefs. Market Briefs is a free financial newsletter where every day my team is working to break down what's happening in things like the housing market, the stock market, the economy, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. If you have not joined Market Briefs yet, it's completely free. And I got the link for you to join down in the description below. Now let's talk about analyzing the numbers. Once you find a good location you want to invest in and you find a good property that makes sense, now let's analyze the numbers. Now remember, the types of returns that's going to make sense for you are going to vary. It's going to vary based on the location. It's going to vary based on the property type. Certain locations like Manhattan and Los Angeles are going to have lower rates of return than Indiana. And so now you got to understand, depending on what type of return that you want, you got to vary where you're investing your money, and it's also going to depend on what type of properties you're looking for. If you want to see the higher rates of returns, you got to look at the more distressed properties because that's going to require more work to get a property turned around. If you just want a steady cash flow, you don't have to put in any work, you're going to expect some lower rates of returns as well. And the way that you calculate this is by doing a simple calculation. You take your rental income, then you subtract your property taxes, your insurance, your maintenance costs, because I don't care how nice a property is, you always want to factor in some maintenance costs, subtract your management fee. Even if you're not going to manage your property yourself, add in a management factor, add in a management cost, because if you wanted to hire somebody else, well, there's going to be a fee to that. And when you go to sell this property, every investor is going to assume that there's a cost for management, and even if you're not paying yourself as a manager, the other investors will, and they're going to factor that cost in there when they're deciding how much money to pay you. So always factor in a management cost, and then I always like to factor in a vacancy cost as well, because I know the tenants move out, and you want to factor that cost in there. And if you can be generous on your expenses and still have a strong profit, well, then you can make money when the expenses are lower than what you expect. I want my real expenses to be less than my expected expenses because then I'm not going to be upset. But if my real expenses are higher than what I expected, that's going to make me a little bit more upset. And this is how you want to now run your analysis. Now, there's a lot of rules of thumbs that you can use here, and it's going to vary city to city, state to state. But here's a general rule of thumb that you might see. Your property taxes might cost you around 15% of your monthly rental income. Your property insurance might cost you another 5% of your monthly rental income. Your maintenance might be around 8%. Your management, another 8%. And then vacancy, another 8%. What does this translate to? Every year, about 1 month of rent for vacancy, 1 month of rent for your management fees, 1 month of rent for your maintenance costs, and then almost 2 months of rent for your property taxes, and a little bit less than 1 month of rent for your insurance costs. Now, is this guaranteed how it's going to always be? Absolutely not. Certain states are going to have higher insurance costs than others, but this gives you a rough idea. And this now will give you what's called your net operating income. Some people like to call this the back of a napkin calculation because you can do this very quickly. And essentially what this is telling you is if you take your rental income and you essentially cut it in half, that gives you your net operating income. Now you might be saying, well, Jaspreet, what if I have a mortgage? What if I have debt? This is where you would now subtract your mortgage after the net operating income. Now, what I have seen, especially in 2021 and 2022, when we were seeing the big boom in the housing market, is a lot of people were investing in real estate with negative NOIs, with negative returns here, meaning they had to pay money every single month to keep these properties because they were cash flow negative. But the reason why people kept buying these deals was because they were hoping that they'd be able to sell these properties for a huge profit in 2 to 3 years. That's not the game that I play. And the game that I play is I want this NOI to give me a 7% cash on cash return on my money. Meaning if I invest $100,000 of my own cash, I want $7,000 worth of NOI, $7,000 worth of profit every year after paying for my expenses. That is a good return for me. Now, in order for me to justify this 7% NOI, I'm not just going to buy this in any random neighborhood. I want this to be in an area where I believe the populations are growing, where I believe businesses are moving to, where I believe people are wanting to move to, where I believe the money is moving to, because that's going to help increase the rental incomes in the future and also increase the property values. Now, for me, property value increase is like icing on the cake. It's great if it happens. If it doesn't happen, oh well, because I still have the 7% cash on cash return, and it also gives me cushion. Because now if we see a recession tomorrow, and now we have to cut rents, well, I still have margin in the deal to cut the rents and still be profitable. That's the game that I play. Because for me, this is a passive investment. And what I mean by that is I take the money that I'm earning, I put some of it aside, and then I invest this money into real estate. Now I buy this real estate and I have it managed by a property manager. Now I don't like the idea of managing my own real estate. That is not something that I do. That's not a game that I want to play because my time is not very well served as a manager. I don't want to have to dealing with tenants. I don't want to have to deal with fixing toilets. I don't want to have to deal with talking to contractors and talking to the city hall. It's a pain in the butt for me, and I would not want to do that. But I can hire a property manager who is good at that. But you're going to have to be able to hire and fire property managers when you see fit. I've had to fire many property managers because sometimes they're good and then they become not so good, and you have to make sure you stay on top of the property managers. But the goal here now is you got to figure out what is this percentage number for you. And this is going to depend on where you're buying and what you're buying. Once you can determine what this percentage is for you, now you just do the math. You take how much money you need every single year to make this number X. Is it $50,000 a year, $100,000 a year, $1 million a year? You divide this number by the percentage that you can generate cash on cash, and this tells you how much money you have to invest today to get that return. So if you want $100,000 a year and you get a 7% return on your money, you have to invest $1.42 million in order to generate that return. And now you can mess with the numbers to see how much money you need in order to be able to live off of your rental real estate. But again, you don't got to buy everything this year. You can buy it in phases as you generate more income. When most people think of generational wealth, they're thinking, I own this home that's worth $600,000 with a $500,000 mortgage. Then I'm going to work to pay down my mortgage to $0. That way then I can pass down this house to my kids. But that's not what real generational wealth looks like. Real generational wealth looks more like this.